My guest this segment is Jason Wilson, a partner with ETFMG Alternative Harvest ETF, trading on the NYSE under symbol MJ. Jason, welcome.
Thanks for having me.
Jason, what is ETFMG Alternative Harvest ETF all about?
It's all about marijuana. We are the only publicly traded ETF in the US right now that focuses primarily on marijuana companies.
Okay, and so do you concentrate on Canadian companies or US companies or a basket of the entire mix?
Yeah, our fundamental guideline for the US basket is any companies we have cannot be in violation of federal laws. So we do not have, the MedMens in there. We do not have, Origin House now, Canada Royalty. But we do have all of the large licensed producers, Canopy, Aurora, Tilray, companies like that. And they make up over 70% of our holdings.
Okay, and ETF Managers Group as a management firm, how much capital under management?
Just shy of $4 billion US.
$4 billion. Okay, and tell me about the management group. What drives your guys, and what's your sort of wheelhouse?
Wheelhouse is all thematic. So I think the first large ETF they're probably broadly known for is HACK. So that's a cybersecurity ETF. So they launched that a few years ago and then became really popular when we had the whole Sony dust up, if you remember that. So that drove a lot of assets into HACK. And then they have a bunch of other thematics as well. They have immunotherapy funds. They have a gaming fund, which is, esports is becoming more prevalent now. In addition to that, they have AEIQ, which is if you're familiar with IBM Big Blue Watson, the ETF's effectively managed by that artificial intelligence. So that's another cool one. And then MJ we launched back actually December of last year, late December of 2017.
Oh, okay, interesting. So the advantage to an investor of investing in an ETF as opposed to investing with a fund or a money manager?
Core thing is efficiency. So with respect in the US, particularly with ETFs, there's a tax efficiency. As units are created and redeemed, it's done through a physical exchange of securities, a creation-redemption process. And what that means is the transactions happen outside of the fund, so we don't have, when there's rebalances, when there's any kind of changing in the constituents for extraordinary events, that's done effectively externally, so we don't have any tax drag in the fund. It also bears a lot of the transaction costs outside with the market makers, the APs that run it. So it's a little bit more efficient from a cost perspective and a tax perspective, and of course you get a lot of liquidity trading on the New York.
So what is the value proposition in terms of a retail investor investing in an ETF versus some other type of asset manager?
The primary one right now is, well, first off, MJ is the only, call it, marijuana-focused fund in the U.S., period. And then just generally speaking with ETFs, generally versus a managed account or picking your own stocks, it's one trade that provides exposure to the whole sector. And there's a lot of folks in the U.S. that are struggling how to pick winners and losers. No one knows how this is going to shake out. We're in the early innings of this game. So what we try to do is provide as much exposure to the cannabis industry in totality. So that's the main purpose behind the ETF. It's a cost-effective way for investors to get that one trade access.
Oh, okay. So then how has the ETF performed relative to other asset baskets in the MJ space?
There really isn't any other asset basket. I mean, this is the interesting thing with thematic ETFs. It's not like you have, if you look at SPY, the big ETF in the US that tracks the S&P 500, you can benchmark it to that. With a thematic, you're really it's a rules-based formula that rebalances quarterly, and you're just going after the segment. So we perform in line with our underlying constituents, but at the end of the day, it's really, we just put in as many stocks as possible that meet our criteria, which is, do they primarily generate the revenues from the sale or production of cannabis or cannabis-related products, things of that nature. And then we filter them through for market cap and liquidity requirements, and such that we can actually trade the vehicle appropriately, and that's what determines what we are. So we track our own index. So at the end of the day, we just perform relative to how the space goes.
Interesting. Then, so how has the ETFs cannabis performed? The cannabis ETF performed relative to the S&P?
Oh well, it's all over the map. Pick your day. I mean, it's like with HMMJ. We started the year with a pretty good run. We fell back off again, and then we ramped right back up, and now we've kind of come back down to flat. So it's depending on your entry points, it's been a it's been a tough slog at times, and a great run at others. It's been a pretty volatile space.
Sure. So in terms of a minimum criteria for a company to qualify it for inclusion in the ETF, what are those parameters?
Market cap, so we want a minimum size, at least a few $100 million in size. We want to have a minimum share price, and that has to do with the cost of transacting in that security. If it's just trading at 50 cents a share, and because we have about $850 million in assets in Canadian dollar terms, even putting in a 1 or 2% allocation, if it's a 50-cent share, obviously can lead to a lot of costs. But primarily it's liquidity. That's another big one, is making sure that the stocks that meet our filter for business eligibility, do they have enough liquidity? Can we actually trade them? If you can imagine that, especially with some of these stocks, we might start with a 3 or 4% allocation sometimes, and if they run up in price, like some of them have, it could turn into a 6 or 7 or 8% allocation.
Sure.
Then if we have to rebalance to bring it back down in line with what our guidelines are at every quarter, we might have to sell or buy a bunch of stocks. So it's making sure that we can go out, the portfolio manager can go out and actually do that.
So what is what is your expectation for the performance and evolution of the whole sector in terms of valuation going forward, say 12, 24 months?
12, 24 months, I think that it's going to be pretty, reasonably stable. We had obviously a lot of euphoria in the space. There was a lot of retail money getting into these stocks. Everyone's really in growth mode. I think that over the next 20 to 24 months, you'll start to see execution on business plans. And that's what we're really looking forward to see, is how these companies that are in the ETF actually perform. And you'll start probably seeing some winners and some losers and maybe a little bit more consolidation. I think you're also going to see other companies potentially entering the space. It could be on the biosynthesis side. It could also be if we have passage of the Farm Act or the States Act with a new House down in the U.S. Who knows? Our universe could expand a little bit too. But I think overall we're going to see in the short to medium term a lot of volatility, but a general trend upwards. But over the long haul, clearly this is a new space expanding globally where we expect to see a lot of growth down the road.
Right. Okay. So the advent of de-prohibition in the United States, I imagine, would represent quite a broad sector catalyst that you would expect to really open up the landscape in the United States. And some asset managers in Canada have expressed that they're already lightening up on the Canadian side and positioning more for the U.S. opportunity in anticipation of an eventual de-prohibition federally. Is that sort of in line with what the ETF is strategizing at this point?
Absolutely. So first off, we capture any company that is in the space legally. So even though we cannot include right now some of the companies with U.S. operations, so up until recently, Afria was not in our fund as an example. But when they divested their U.S. holdings, then we're able to include them on our next rebalance. But we're seeing with a lot of the companies that are in the fund right now, how they are in fact positioning themselves in the U.S. Where they're either doing that through partnerships or acquiring, looking at research opportunities, or maybe it's on the branding side, licensing side. I think we've seen TGOD do a number of things in that space recently. So it's the fund through its constituents is definitely benefiting from that,
right,
as well as the global expansion. And ultimately, when there is, even if it's through the States Act or through the Farm Act, if that makes its way through Congress next year, we would then be able to start putting certain of the U.S. companies into our fund as well.
Okay, so is the objective in the management of the fund to manage volatility on behalf of the unit holder, on the ETF holder, and is that part of the attraction?
I wouldn't say to manage volatility directly. A large part of what the portfolio manager does in a thematic fund like this is making sure that the fund goes in and out of positions if it ever needs to change its weightings prudently. Okay. So that is part of it. And if you think of it where if suddenly we have to, if one of the companies doesn't meet our criteria and we have to remove them, you can't just sell all those stocks in one day. So that's one thing with the ETFs, even though you track an index in theory, the index the next day will suddenly not have that stock. The ETF might not be able to suddenly have that stock. It wouldn't be prudent to just go out and sell it. So yes, you're right that they allow the investor to track the index and maybe sometimes not so precisely because of the volatility it could cause in the market. So that's a subjective judgment call. But the bigger benefit to the investor is to be able to participate in the whole space in one spot.
Okay, well that's really interesting, Jason, and we appreciate the insight, and we'll have you back on the show at regular intervals as this whole sector unfolds. Thank you very much for joining me today.
Thanks for having me. Appreciate it.